Stock markets were bumpier, especially international, due to political and economic concerns and talks around tariffs in the US. Bond markets were weak due to concerns about current stubborn and possible future inflation. The US economy is strong, with a chance of a recession still existing. There are questions and uncertainty about unconventional policies in the upcoming administration in Washington. And we have the new capital market projections for the next 10 years. We'll cover that and more today in this quarter's Quarterly Context. Welcome to Quarterly Context for the fourth quarter, or about the fourth quarter of 2024 for clients and friends of the advisory group. I'm Greg Patterson, CEO. For those of you not familiar with the advisory group, we're a wealth and life strategy firm focused on helping business owners and leaders and others with their financial goals in their personal and family realms, their fiduciary and employee support efforts through retirement plans, their communities through foundations and endowments. To complement the strategic work we do with clients, our Quarterly Context webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, investor behavior patterns, and more to help clients stay more relaxed by staying informed and make the best decisions they can towards their goals. We will have this presentation has two sections. We only cover one in this webinar. The second one is available by request in client meetings. And we try to keep this to about 20 minutes or a little more. And we'll also circulate a video link should you like to view it again or some part of it, or pass it on to someone you think we can help like we've helped you. And if you have any questions, please submit them to the question box. So we'll cover, as mentioned, a number of things today as usual, and our regular reminder that it's important to focus on that space between the things that matter and things you can control. That is the key focus area. You can't control markets or politics or the economy, but you can control how you plan and how you respond wisely around those outside events. The advisory group is all about helping people improve lives for themselves and others through financial advice, and it's a pleasure to be with you here today. As always, and even seemingly more so this last quarter than many, there were quite a few news events between inflation being stubborn, the deficit hitting almost 2 trillion, the relatively solid economic status of the US, the election outcome, Fed rates getting cut again twice, the dramatic shift in Syria in terms of the government and what the implications are for their sort of foes and allies, the Fed signaling that rates will continue to be cut, but on a slower pattern. That made markets nervous for a couple of reasons. The market took a bit of a fall after that news, and despite all that and quite a bit happening, it was overall a strong year and the best 2 years in a quarter century for stock markets, in particular in the US. Looking at some key top-level metrics, rates. Again, had 2 quarter-point cuts in November and December. This follows another cut in the prior quarter, and this follows 11 consecutive hikes in the Fed's attempt to control inflation. And inflation has come down, now hovering around the 3% mark, up from down from 9% at the peak in 2022. The stock and bond markets were not as strong as last quarter, which were unusually strong in both, especially for bonds, with the initiation of the rate cut period. Stock market, the broad U.S. market was up 2.5%, bond market down 3%, primarily over inflation concerns, because if inflation is more difficult than expected, and if there are factors that might cause inflation to rise in the future, that might lead the Fed to increase rates, which hurts bonds. So the bond market is looking forward out into the future for some of those possibilities and being conservative in their how things are priced now. Overall unemployment stayed about the same this quarter versus last quarter, up about 0.3% from a little more than a year ago. So inflation is rough, unemployment is roughly stable, but has picked up. And GDP or economic growth numbers also fairly stable, hovering around that 3% mark, but with forecast for the 2024 fourth quarter numbers to end up around 2.2%. Stock and bond markets, as mentioned, were bumpy last quarter. This was all green. Now we've got a few red spots in the top, and that flowed through to create a red spot out in the 5-year mark in bonds. The U.S. market, 2 negative months, 1 positive month, ended up in the positive territory. Still saw this comes out to more than a 10% average annualized return, but weaker than a lot of other recent quarters. International stocks, emerging market stocks, real estate, all cooled based on concerns about either their local economies and perceived increase in chance of recession abroad, and currency dynamics with the dollar pushed returns down as the dollar strengthened a little bit this quarter after weakening in the prior quarter. And then tariff talks and other dynamics in the U.S. Also spooked investors a little bit, especially in the emerging market side, where there may be more product and supply flows that might be impacted by those tariffs. Still, however, despite some of those bumps, we have a 24% return in the U.S. for a 1-year return, almost 8%, 7-8% for emerging market stocks, about 5% for international stocks. So not a bad year overall. Not the best year for some asset classes, but pretty solid overall. We look at the 4 biggest market downturns and their recoveries. This purple line really includes both the global financial crisis and COVID and the rate period. So a combination of periods, but it's interesting to see how other major market drawdowns in the past had a tougher time, did bounce back, but also just to show that it can happen, that markets can have longer recovery periods than the one we've seen. This chart here is shown after inflation, whereas this chart here in the middle is shown before inflation. Seeing the red line, which was the 70s oil and financial crisis, actually had a similar before inflation return, but it was an even higher inflation period than what we've experienced in the last several years. These grids show different time periods for different small, mid, large value blend growths of different U.S. stock categories. And as we've talked about in the past, large cap growth has been one of the stronger or the super strong component of markets, really driven by the Magnificent Seven, a small group of stocks that have really now reached about 35 to 37% of the market capitalization of the S&P 500 index. And we've had discussions before about how that may persist for some period of time, but can't last forever. There's increasing talk and concern about the sustainability of earnings growth for those types of companies, where the the growth rate of earnings is just difficult to maintain when you consider the markets, even if those companies have, in some cases, seemingly infinite scale and increasing market share. Those Magnificent Seven and other growth stocks have really helped push up valuations in the US. It's now hovering materially above the normal one standard deviation range around the average. Typically, when that's the case, there is some sort of more significant volatility on the horizon out in the next several years. Whether that's this year, the following year, the year after that, or a little later, it's impossible to say. But we do want to remind investors and clients and others not to be overly aggressive relative to what your needs are, because that can come back to bite you if volatility or when volatility rears its head. That doesn't mean it's immediately on the horizon, but by definition, there will be some sort of cooling at some point in the future, just as a natural part of market cycles. Here in this chart, you can see the US is relatively high in valuations compared to the history over 20 years. And some would say that part of that difference versus the long-term average may be justifiable given the really high scalability of those big companies. However, others would say that those valuations are stretched. Compared to other countries and regions where stock prices are much more attractively and reasonably valued, although some of those regions and countries have more geopolitical risk, at least in terms of their neighbors and proximity. That's making some investors nervous, but still attractively valued. And when things are out of favor and more attractively valued, they tend to revert to the mean upwards. And when things are overly valued, they tend to revert downwards towards the mean over time. Another chart or set of charts on valuations. Here we can see the US, and we're not suggesting anything will happen here in the immediate term, but we do want people not to be overly excited about what's happening in US returns. And when you have friends or neighbors or you're at a cocktail party and people are talking about how well a couple of their stocks are doing, you may quietly be have mixed emotions about that, because you may feel like you missed out a little bit, but you also may feel much more comfortable knowing that you're diversified and have a much lower risk profile versus something, a segment of stocks or a small set of stocks that, even broadly speaking, the category of stocks and growth stocks that have been flying high and valuations are stretched and could come a little closer to earth at some point. If we compare that to international, you can see where the variations have been less volatile, especially recently in terms of valuations, and are attractively to normally priced now. You can see here as well on a country by country basis how that compares with the US in terms of PE ratios, quite a bit farther out than most the country. You see the world here is actually in great part pulled out by that US number as well. This is something we showed last quarter, but just wanted to show as a reminder, and we'll talk about the Callan capital market expectations in a few minutes. But as a reminder, there are some organizations that are projecting, this one came from Vanguard, that those large cap growth stocks, the 10-year projection is 0 to 2%. So whether or not that plays out is anybody's guess, but it is increasingly part of a conversation in the industry. You know, what's overvalued? How far overvalued is it? Will there be? How much reversion will there be to the mean? And their projections are that large cap growth, or U.S. growth in general, pulls down the overall U.S. numbers in terms of projections, whereas international is in the 7 to 9% range. Again, hard to say, and as we'll see in the Callan capital market expectations, it doesn't break it out by sub-asset class, but it does show a little bit lower for international, a little bit higher for US. Here we can see inflation has been hovering around its recent numbers, around that 3% mark. Came down a little bit a month or so ago, came back up as of a couple of days ago. So there is some nervousness out there around that, because the longer inflation stays high, the more likely the Fed is to do fewer and smaller interest rate cuts. And the longer interest rates stay high, the more that slows down the economy and the greater the chance there is of some sort of recessionary environment. But that's an important part of the Fed's role, is not to, at the same time, cool rates too quickly, because that could lead to an acceleration of inflation. Again, just to see the long-term rate pattern here, there's an extended period of rates coming down after ratcheting them up during that high inflation period of the 70s and early 80s. Then stimulative period after global financial crisis, ratcheted up to try and get back to normal. Then COVID happened, heavy stimulative period brought it back down to zero. And then we've seen the high rate period trying to control in inflation. Inflation is a very common response to heavy stimulative monetary policy. So this rate cut became necessary to control the inflation that was a unfortunate but expected side effect of trying to prevent depressions by the stimulative policy during these periods here. Now we're entering a rate normalization process. The Fed is trying to bring it back down to closer to 3%, somewhere between 3 and 4%, and but can't do that too fast because it might trigger inflation and overheating the economy. What's interesting here on this chart shows the Fed hikes and drops over time, as well as the market projections. So here, the Fed and the market is roughly in sync, going through kind of the current times and maybe out a little bit into 2025. And then the Fed is expecting rates to come down closer to 3%, and the market is expecting that they will stay closer to 4%. So the market is expecting maybe more of a battle with higher for longer inflation than the Fed is. The bond yield curve shows something about the bond market's expectations about the future. So normally the curve moves up and to the right because shorter term bonds tend to have lower rates than longer term bonds. The recent quarters, ignore the blue one, which is the end of the year, had more inverted curves, and previously they were even more inverted than this. Inverted is when the short end is higher than the long end. Right now, we've got a kind of a mixed curve where it's normalizing out from near the short end out to the long end, although still pretty flat, not normally as steep as it would be, but still a little bit inverted here at the very short ends, showing some sort of mixed feelings about the direction of the economy. So something to keep in mind, just keeping the pulse on different thoughts out there in the marketplace. Unemployment, as mentioned before, has been hovering around that upper 3s, low 4%, but has ratcheted up a little bit. And the wage growth rate has come down since the peak in COVID and is still declining a little bit, but starting to hover at a more even level. So that some would say could be a factor that could lead to inflationary pressure if wages start picking up and inflation is cooling down and people feel like they are more comfortable spending. That could lead to some price boosts, which complicates the job of the Fed. Consumer confidence picked up a little bit, and business confidence ticked down a little bit. So that chart's not shown here, but separately, we're seeing numbers from business surveys. Then we get to the question of 2025 scenarios. We don't often talk through a full year. We thought, given the change in administration and some unconventional approaches to governing. There might be some things to think about. So we wanted to sort of summarize what we're hearing from different sources about. There's no clear answers about what will happen, but some of the talk and implications. So overall, starting with a relatively strong economy, some people are looking forward to the changes, not just for political reasons, but because they believe across different camps that there could be some positive economic outcome from some disruptive change. Others are more mixed, and others are much more concerned about that. When we talk about the specific implications, in general, the discussion is around higher uncertainty. Higher uncertainty tends to equate to higher volatility, but we'll have to see. There's some excitement in markets about the potential for growth, sort of that's being reflected in some of the US numbers in the short run, but there are some implications for what some of those policies might cause in the medium or longer term. So elements that could help growth, the idea of lowering prices through increased supply, cutting taxes, that also has deficit implications, and there's a big sort of ongoing battle there. Reduced regulation, so depending on where that regulation happens, that can typically higher regulation dampens returns but decreases volatility. Less regulation in general increases volatility and can increase returns. So if we think of the global financial crisis, that was really a consequence of a gradual deregulating of the financial industry and led to a monster-sized second worst crash in the history of the US. I'm not saying specifically that will be a result of this next administration, and we don't know if financial regulation will be cut or other areas, but just pointing that out as context. Interestingly, there's an internal debate within the Republican Party about immigration, and leadership is, key leadership is focused on allowing work visas for highly skilled labor to help increase innovation and business leadership. However, on the other side, mass deportations is being discussed, and that could decrease the workforce, increase wages, increase product prices, increase inflation, and harm competitiveness. So that is an interesting counter dynamic there. The talk of tariffs, typically higher prices, which by definition leads to higher prices, which by definition increases inflation. And historically, that's often hurts not just the importers or the countries that are importing, or countries and companies, but also consumers, because a lot of those price increases end up being passed on to the end consumer. So that is not an obvious win, and historically it's a lose-lose scenario for both sides, but we'll see what happens there. If these dynamics lead to higher inflation, the Fed normally raises rates, which slows the economy. So that could be a medium or longer term dynamic. And rates might not go up if the Fed gets a lot of pressure from the new administration and is less independent. But that can increase concern about the economy and overheating, which would eventually lead to higher inflation anyway. And that can lead to bigger crashes and or higher interest rate and steeper interest rate shifts if there's a future administration that reestablishes the traditional role of the Fed. It's not clear to what degree the Fed might become less independent, less independent, but this is one of the concerns that's being discussed out there in the economic circles. There's also talk about the possibility that some of the policies of the next administration may be much less extreme than the campaign rhetoric, and that could reduce some of the concerns that are outlined here. It could also reduce some of the growth prospects, at least in the short run. So interesting combinations. And then there are geopolitics which overlap with this next administration, but also in isolation by themselves that could have impact on 2025 in unpredictable ways. So all of that, we always, what is the chance of recession? There is the general consensus that the economy is strong but slowing, and the question is, will it go into low growth mode or into recessionary mode? And we've seen some interesting numbers around the probabilities of that. So there's a sort of a no recession scenario, and there's a, through strong fundamentals, and then there's a no recession scenario around a very quiet, gentle landing, and in the middle, there's the kind of problematic inflation story, the inflation even stronger, and then maybe more extreme policies, some of which we discussed a moment ago, that might lead to even bigger inflation or other concerns or dynamics with 15, 30%, and 45% chance of recession in the first half of 2025, the second half of 2025, and sometime in 2026. So less than 50% chance based on this projection, but about 50-50 here, which is not surprising given that it's been a while since there's been a recession, and they will happen eventually for one reason or another. Now we can talk for a minute about the capital market projections from Callan. Just summarize by saying that overall, we focus on the 10-year geometric returns, not the arithmetic returns. The geometric returns reflect the compounding effect and the incorporation of volatility, which produces a returns more similar to what you would actually experience, whereas the arithmetic might be any given year, but before considering volatility. So the 10-year numbers here, we mostly focus on equities and fixed income. Can talk some other time about the alternatives, but for most of our clients, good access to some of these alternatives is just difficult because of minimums and fees and liquidity and transparency concerns. But we continue to keep an eye out for vehicles that may become helpful in that regard and that are better for investors that are sort of under the 100 million size. However, we have had some indirect exposure to some of these components through some of the underlying investment managers. But back to the more traditional markets, stocks, if we compare the 2024 numbers, geometric returns versus 2025, projections are down by, the 10-year projections are down by about 0.3% on average. And the bond projections, given that interest rates have already come down a bit and got some of that yield compression has already happened, and given other variables, depending on the component of the asset class, our projections, the yearly projections or the average projection per year is down by about 0.2 to 0.9. The 0.9 is in the longer bond section here, long credit in particular. But overall, still, we're talking about the 4 to 6% range for the most part for bonds, which is a much better place than we were a few years ago, where it was hovering in the high 1s, 2% range when we were in that near 0% Fed rate zone. So to wrap up here for capital market projections, volatility is identical or very similar. So it's mostly just a reflection here of the strong markets that we've already experienced in the recent years between stocks and bonds. And so the Callan projections tend to very gradually fluctuate around what's happening and what's projected, incorporating those two factors. And we will talk about this individually with clients as needed as it pertains to their particular needs, goals, and planning. We have some new blog posts, as always, that you might find helpful and interesting around tax planning, one around endowment advisors. We've encounter a number of endowments who are realizing that they have maybe a reasonably good investment advisor, but it's really not an endowment advisor and isn't helping them with spending policy and MIFA and other regulatory dynamics. And then mistake avoidance during a divorce, how to protect your parents from elder financial abuse. This is both a blog and a webinar. I think the webinar isn't quite posted to the video section of the website yet, but if it's not, it will be soon. And this is helpful. You can really make a difference in someone's life that's in your family circle by helping them avoid those problems. As mentioned, part 2, we will be happy to cover for you if you like in the future in a meeting. We won't cover that here. It really goes deeper into some specific data and then some broader patterns as well. So thank you for being here today. We'll check if you have questions, please start to plug them into the question box. But we appreciate you being here. It's always a pleasure to support you as friends and clients of the advisory group. And if you know others that we can help like we've helped you, we thank those of you that have introduced people to so that we can increase the number of people and organizations that we support and the lives that we help improve. So let me pause there, and questions in a moment. And if you're going to hop off, thank you for joining today.